In my previous market structure training, we talked about my interpretation of how to read the structure. In this video, is going to take it one step further. First, we're going to review what has actually happened now that some time has passed and talk about the characteristics of the various candlesticks that have formed on the S&P 500 index. Next, we're going to compare the market structure of the S&P 500 with another index that has diverged. And last, I'm going to share some rules to consider for your top-down multi-timeframe analysis. So let's get started. Right now we are sitting in replay mode on the S&P 500. Replay mode is a very handy tool that TradingView offers you. You can use it on pretty much every single time frame, and it is a great tool to utilize for your backtesting. The date that we were looking at this chart last was June 26, 2020. We had one price level specifically marked up at 29.75. And we talked about how although there were various possibilities on how price might trade down there, we essentially wanted to see a lower close within the next week's price action to be able to have a higher probability of seeing 29.75 traded to. If we take a look at what happened on the following daily candle, we can see that the wick did trade lower. We actually traded through the whole level of 3,000. But then what we saw was a bullish candle close. Keep in mind, it was still a lower close relative to where the previous day opened. We can mark up the open right there, and we can visibly see that it was a lower candlestick close. If we were to do a quick measurement, it was lower by about 30 points. But this candlestick right here, when we are reading structure, one thing to understand is that when we take a look at the open, high, low, and closing prices of each candlestick as they form, and we are speculating on what it is that's going to be happening, whether that be in the short term or the long term, the closer that we get to the open of whatever candlestick that we are referencing. So in this example, the closer that we get to the price point of 3085, the lower the probabilities are that this particular idea is going to be working out at this time. If we fast forward to the next day, we can see that we did get another candlestick that was higher than where the first bullish candlestick of the week began. And at that point, we had taken out the high of that particular market structure. Another thing to keep in mind is that when we're looking at the chart, you need to consider the time. Price and time go hand in hand. In this particular instance, we were coming up on the end of a monthly candlestick. As you can see, the very next day, we did transition into July of 2020. And if we were to just kind of play out everything that's happened between when we looked at this last and where we are now, we can see that we had consecutive bullish candlestick closes. We eventually came up, ran out the highs on all of these wicks, and returned to the first candlestick that really started that market structure shift after we got a reaction off of that last key level that we were previously taking a look at. At this point in time, trading below 29.75 will have to be postponed to use as a future price target when the market structure is a little bit more clear. What observations can we make? When we come down into a 4-hour time frame and we go back to the price action that we were previously looking at, right in here, we can notice where the week came to a close. The specific candlestick was this bearish one right here. That was the last 4-hour candlestick close for the daily candle we were looking at. The first 4-hour candle of the following week, we traded down. If we were to mark up the low of that candle, we can see that it traded almost to this last area that we were looking at in the previous training. We then saw the first few hours of market open starting to give us some signs of strength. And if we drop it down into an hourly chart and we go and do a little bit of exploration, we can see a little bit more clearly what the market did the very first hour that we were open. We got a push down. So the market came down, made a low, and then immediately after we came up, traded beyond where the market opened. Some brokers would have displayed that as a gap. So any traders that would be looking for that gap fill or even to see the market trade beyond it would have had an opportunity to position themselves. And then again, we see the market all the way up until New York open trade higher. So if we're reading the structure, we had market open, push down. We come up. And then we get that higher low. We get that higher high. Coming back to the whole idea of price and time. New York open candle, 9 a.m. Eastern, that hour. We see the market push down one more time. And so what would happen if we were to come into something like a 15-minute chart just to get a little bit more refined? We can see right here, this was that New York market open candle. We pushed down, we traded towards where the low of the week was. We failed to actually hit it. And then we started to see some strength. And by the end of the hour, we had traded beyond where New York market opened previously. Then coming out of replay mode and going all the way back, we can see that after that movement happened, the following hour, we had an engulfing candlestick that had formed. And we can see some pretty clear targets. We've got some highs in here, we had imbalance here, and the market slowly made its way towards that as we headed into the last trading day of June. And then heading into July with the bullishness that we had seen, ultimately price has ended up continuing a little bit higher. With where price action has traded to, we can see things on the chart such as gaps. If we were to walk it back to a higher time frame daily chart, we are in a little bit of a consolidation at this point. Weekly chart, we did get an engulfing week heading into the month of July. And then monthly chart, we did have a bullish candlestick close for the month of June. So if we were to speculate on what price was likely going to do, at least over the next couple of months, potentially even heading up to the election, we could see this pushing higher. And we're going to talk about why that could potentially happen when we shift into the topic of divergence. Now, if you don't know what divergence is, we are going to talk about that here real quick. I want you to know that there are a couple of ways to look at divergence. Essentially, divergence is when the price of an asset It could be a currency, a commodity, a stock, it doesn't matter. But divergence is when the price of an asset is moving in the opposite direction of a correlating chart or in the opposite direction of a technical indicator. So some traders, they compare the data of one price chart to another, which is what we're going to be doing in a moment. While other traders are going to use a price chart in comparison with an oscillator, such as the RSI or the stochastic. If I were to go ahead and put on a relative strength index, the RSI, we're just going to leave the settings the same. Right here, when we are looking at the daily time frame, you can see an example of negative divergence on this chart. If we take a look, we had the price within the candles moving higher as we were trading to the old all-time high. While at the same time, the oscillator, the RSI, was signaling the possibility of a lower move. If we take a look at the crosshair, and if you look up from when the oscillator had its high, what ended up happening? We saw the market within price action initially have a dip down. We see that in the oscillator as well. Then price action comes up and makes a new high. And what we end up doing is we consolidate really tight right near that 3,400 whole level. While this is happening, the market does spend several days trading up at that level. We can do a quick measurement and see that we were up there for about 9 trading days. What we saw within the oscillator was a negative divergence. We see the RSI make a lower high, while price action made a higher high. And this example of negative divergence within the indicator showed us that there was a probability that that sell-off that we see could be happening. And even if we go and take a look at what price action would have looked like back then, we can still see pretty clearly that divergence in play. And then as the market sells off, we can see how the RSI continues moving in that same direction. So the divergence essentially gets reduced and eventually brought back to a balanced point where they're no longer diverging. Keep in mind, divergence, especially when you're using technical indicators like an RSI or a stochastic or a MACD or whatever other indicators you feel you need to use, they are not something to be relied on exclusively. I personally will never take a trade based off of pure divergence. I'm always looking for more confirmations and more evidence to increase the confidence that I personally have in the setup. We are going to go ahead and take off this RSI now, and we're going to transition and take a look at an example of a positive divergence now. Make one mental picture real quick of where price action is for the S&P 500 relative to its old all-time high as of the time of this recording. For reference, we are going to quickly take the fib retracement once more so that you can get a visual reference of where price currently is. And keep in mind that by the time that you're watching this training video, there will be new candles. The divergence that we're about to take a look at may no longer exist. It will ultimately be up to you to do a new and thorough analysis to decide what is the probabilities of the next price movement for whatever market you choose to look at. So let's take a look at an example of a positive divergence, and we're going to do that by looking at the NASDAQ. Now that we're on the NASDAQ chart, let's start by identifying the June 26th candle with our replay mode feature, because that was the last time that we were looking at the S&P. As we can see, this is what price looked like. And you'll notice the old all-time high for the NASDAQ, right around that whole level of 97.50. So we're going to mark that up just so that you have a visual of the quarter level and the old all-time high. In quarters theory, remember, there's a lot of power that goes into these whole numbers, like 10,000, 9750, 9500, 9250, 9,000, so on and so forth. But as we can see in this example, even when we were trading on the 26th of June 2020, there was indeed a positive divergence happening within the price action of the NASDAQ 100 in comparison to the S&P. If we really wanted to dive into it, we could utilize the compare tool, and you could overlay another chart such as the S&P 500 onto the NASDAQ. But we're going to save that for a little bit later, and I would encourage that you personally go and do a little bit more exploration if you're interested in understanding the divergence even further. As we can see though, the positive divergence with price making a new all-time high, whereas the S&P 500, as of the time of this recording, still has not traded through its old all-time high. If we were to allow the market to move forward to where we are as of this time, look at the significance of the movement that happened. Do you see it? What we're going to do is walk through this structure while simultaneously laying out some rules to consider when you are doing your multi-time frame analysis. Whether you're doing a top-down, whether you're getting into the smaller time frames, here are some things for your consideration. We're starting off on the daily chart, and we are taking a look at the NASDAQ 100. We've got the old all-time high marked up. It's a quarter level. And the reason why we're starting on the daily chart is because the daily is really powerful for direction. Utilizing something like a daily chart, when it's condensing an entire trading day worth of information into a single candle, can be incredibly powerful when you are considering what is the direction that the market is likely heading in. If we're utilizing the daily chart for direction, what we're going to first do is come all the way back to that movement that happened from the old all-time high to the low of the sell-off. So we've got the high marked up. We're going to consider the low as 7,000. And the reason why I'm considering the low as 7,000 is because that's where the majority of the candle bodies are. Even if you take a look, we do have some wicks coming down and hitting 7,000 before we ultimately saw the low get set. but the majority of where these candles were closing, where they were opening, and even where we started to see that strength come into the market after getting a smaller time frame spring formation, all of that significant price action occurred right around the 7,000 whole level. So this was our range from where the old all-time high was to where the sell-off had ended for this period of time. What we could also do is we could take a measurement with our Fibonacci. We've got some extensions on there, and what we're going to do is just kind of mark it up with a box for this moment between the 141.4 and the 127.2. And we're going to clean up the chart. We're going to take the fibs off. And what we're going to do at this point is shift into the next time frame down that we're going to be considering in this training, which is the 4-hour chart. The 4-hour chart, how I personally like to use it, is for identifying market structure. So we're using the daily for direction. We're using the 4-hour chart in this particular example to help us identify and interpret the market structure and give us a clearer idea of what actually happened. So let's go back. Starting off, we have the old all-time high down to the low. If we take a look at all of the price action that occurred, and we can utilize the replay mode if we'd like, a couple of things to make note of. One, as we were selling off from the high, there was imbalance formed. The most significant one that I can personally see happened right around the 9,000 whole level. This candlestick right here, it was a market structure shift. We came down, we took out this low. Market structure shift, we then traded lower. We came back and attempted to return to it, but we never had the opportunity to trade completely through it. So you can see that right in there. As we mentioned, when looking at the daily chart, there was a spring formed. We can see that a little bit more clearly. All of those wicks, all of those candle bodies, we get that last push down. And then look at this. We see lots of strength coming into the market. Nice big bullish candle. We return to that lower point of structure one last time. Trade very, very close to the 67.50 quarter level, and then boom, we come up and we make a higher high. So if you're having difficulty reading this, if you're having a little bit of difficulty understanding the significance of what happened in here, I'm going to kind of annotate it for you. As we were selling off, once this happened, we had a high, little short-term high, we had a low. On the strength that we saw in here, look at the candle close. We got a break of structure. And we successfully traded beyond this old high. Now, this is significant because if we're looking at the entire sell-off, from the high down to the low, selling off, the market bounces. If you pay attention to those candles, lower highs. Even taking a look at this right in here, that was lower relative to this structure. So even though we saw some wicks trade beyond, we didn't actually get a market structure break within this price action. We then see the selling continue. The market selling off, selling off, selling off. We get this little bit of buying in here. Market sells lower. We come back to revisit it. We do not get a market structure break. We trade lower through the 7,800 level. We touch 7,000. We get a bounce, lower high. You can see that. We consolidate, 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 lower high once again. Market structure shift to the downside as we see a continuation of the sell-off that was happening. And then it wasn't until this moment where we actually got a break of structure. So we made our potential spring. Market showed us that there was a potential willingness to go higher with a market structure break, successfully closing beyond these candles. So at this point, we have our low. And we recently had a market structure break. A break of structure. At this point, if you were wanting to understand price action, whether you were looking at this in the moment and interpreting, well, what's going to happen tomorrow? What's going to happen on the following day? Or whether you're using this like we are right now as an example, something to train your eye and something to learn on. Daily time frame is great for direction. And in my opinion, the 4-hour chart is really, really powerful for helping us understand structure on a macro perspective. As the price continues, we again see another high created. And so at this point, what we'd be wanting to see if we are going to be transitioning to a bullish condition, we're going to want to see this high get traded through eventually. We now have a higher low, getting ready potentially for a higher high. Notice what's happening within the price. Okay, and we're going to stop it right here. The low that we had marked from when our spring happened to that first break of structure and then the retracement. If we were to extend that, whether we're looking at the wicks or the bodies of the candlesticks, that low was kept intact. If we're looking for a break of structure here, and we're waiting and waiting and waiting for that higher high, all right, we get it. And so now our eyes would go here, that next intraday high. And then we have our new low. Waiting and waiting and waiting. Maybe you're positioned, maybe you're not. But as we read the structure, there we go, our break of structure. We now have a higher low. We could be looking up here. Allowing price to develop. And one might argue that that was a break of structure. But if we take a look, remember, we got to take a look at the bodies of the candles. Very, very close, but that, in my opinion, is not enough for a successful break of structure. I would still want to see price trade through that to confirm that we're setting some sort of a higher low. You may be looking at that. You may be looking at that. You may be speculating that this is the higher low in formation. So let's see what happened. Giving price some more time to develop. We trade up and very, very close to that point in the market again. We can see that the candlestick this time around did trade a little bit higher than before. And then with a little bit more time, we eventually do get that break of structure and we return all the way back to that imbalance that was created near 9,000. Okay, so we got the break of structure. Now we could be looking here, that next point where there was some structure formed. The market spent a little bit of time there, and it's just before the sell-off really began. So looking for that higher high to get formed. We could use that as our higher low, that as our higher low, that as our higher low. And allowing the market to do its thing, we eventually do get that break of structure. Letting price continue on, just for the sake of time. Notice as we're getting back closer and closer to the old all-time high. So what's actually happened? We've been taking a look at the structure as it developed from that first point where we saw strength with our spring formation all the way up to where price action had returned to its old all-time high. We had lows get set. We had highs get set. We had higher lows and higher highs. Higher lows and higher highs. And the market structure continued to walk up, making higher lows and higher highs. And then as we approach the old all-time high, and we're doing some diving to understand the structure, eventually we get that break. Nice, clean 4-hour candle close. To allow some more time to develop, we continue seeing the market showing us that there is still a willingness to go higher. We get another higher low relative to that last point of structure. We had a higher high. And again, we see that price action continue. And at this point in time, we're all the way back at where the replay mode started, June 26th. So this was the price action of where that week ended and where the last trading week of June started. So when you're reading this, you can see those higher highs and higher lows very, very easily from a 4-hour chart. And you can also use the 4-hour chart to better understand, well, what's actually happening within the price action as it's developing. Now, the significance of what happened off of the old all-time high as the market was getting ready to potentially make a higher low and then head for a higher high. We saw the market come down over a 4-hour period of time. We traded into the old all-time high, that 97.50 level. We actually traded through it by 7 points. And we can see that. Then we got a bullish candlestick close. From that point, we saw more strength, break of structure coming up. New all-time high was formed, higher high. So if we were to let this play out all the way to the current price, at least as of right now, we are continuing to see strength in the market, and we could very well see this trade beyond 11,000. Now, using the 4-hour chart for structure in combination with the daily chart for direction can be very, very powerful. The third time frame that we're going to take a look at is the hourly chart. In the hourly chart, although we're not going to go too deep into it right now, if we were to lay down the 3 time frames one more time, daily being direction, 4-hour being market structure, the hourly, at least with how I use it, it is to refine and execute. So as I'm going through and reading the market structure, and after I have an idea of the direction, the hourly chart is where I'm looking to refine the areas that I'm looking at. Say, for example, when this spring formation happened, and we had that first sign of strength, really, really, really strong bullish candlestick. Time and price, we got New York market open, market came back down and returned to where that move started. On an hourly time frame, you would have been able to identify a very low risk, high reward setup based off of an expectation that the market would eventually return to an area like this, near that 6750 quarter level, not exceed the old low, and then eventually come and give us a break of structure. In this potential hypothetical example, although in hindsight, we can see you would have been able to find a 4-to-1 risk to reward just basing your idea off of a break of structure. Now, of course, we know that the market never returned to there. So as price continued to develop, if you had positioned yourself in this particular example, just to show you what's possible, very high reward to risk, 20-to-1 as of this time, as the market has moved about 4,000 points higher since the initial market sell-off. Now, I'm not saying that I participated in that. I'm just showing you for the demonstration of how you could actually refine your analysis that you've done on an hourly chart. You're going to be able to pick up things that you may have missed, such as imbalances, these clear visible gaps that on a 4-hour or a daily or something higher, you may not have noticed. But keep in mind, once you start diving into the smaller time frames, and in my opinion, anything under the hourly chart is considered a small time frame. There's going to be more noise because there's more data that needs to be considered once you start getting into something like a 30-minute chart or a 15-minute chart or a 5-minute chart. Whereas the higher time frames like the weekly and the monthly and the yearly give you the advantage of condensing a lot of information into less candlesticks. So these time frames, they are to be used together. The reason why we focused on 3 is because typically 3 time frames is all you need to get a clear picture of what has happened, as well as form an idea of what could be happening next. When you're using 3 time frames, you can do an analysis in about 10 to 15 minutes once you become proficient. Even though you can use every single time frame, all the way from the tick data to beyond the yearly. Make sure that when you're doing your analysis, you have the right expectations and you consider your possible targets, possible risk parameters, and potential